Hello again and welcome. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us on our Friday Insights edition. Today is going to be our last day of April 2021, and we're going to take a look at year over year of the U.S. economy. So thanks for watching our Friday Insights. So here we are a year over year, April 2021. So a year ago, the world was at a standstill. The U.S. economy was a standstill. The GDP for the next quarter, if you will, in 2020 was a negative 31%. And then we opened back up slowly, smartly, and more importantly, the vaccine rolled out. And here's where we are a year later. Well, with the help of both quick and swift actions by fiscal and monetary policy, obviously we saw a lot of money in the hands of the U.S. consumer and small businesses to help them survive through this period of time. And it looks, like a lot of things are opening up quicker and faster. And then, in fact, if you look at the U.S. economy right now, there's a labor shortage, even though we're at a 6% unemployment rate. But a year ago, we were well over 14%, 14.8%, which is the highest since past 50 plus years. So the U.S. economy was strong going into the COVID-19 virus that put everything on a standstill, and now it's bouncing back even stronger right now. So as we see initial claims on the U.S. economy going lower and lower and lower, down to about 500,000, and unemployment is around 6% right now, still high, but it can do better, and the trajectory or the downward on that number is in our favor as the economy opens back up. Every small business person that I'm talking to, whether it's a restaurant owner or even a small business owner, there is a labor shortage. They can't find enough people to come back to work, and that's a good thing. So that we know now, just by empirical evidence, that trend line of our unemployment rate that's currently 6% will start drifting and continuing to get lower, is what the Federal Reserve is also focused on, because that's how they're providing the backdrop to the U.S. economy at this moment. In the meantime, they're bridging the gap for all these corporations and all these small businesses to get back on their feet. Well, what we know now, and the corporate earnings report, is corporations can make a lot of money. In fact, they're record earnings, and that's translating into record highs on all the Dow Jones Industrial Average, S&P 500, and the NASDAQ, all the indices respectively. Now we shift to housing. Housing's a double digit. Who would have thought year over year pandemic world would now result into a housing boom, right? Now a housing shortage, short on supply, and then the prices year over year, not only on the building costs, the cost to actually build in a new construction, but there's short supply in new construction and existing home sales that are being listed on the market. And that's causing, again, another sort of pull forward of higher prices on housing. So the economy is heating up. Now, how do we know this? Well, the GDP was just reported, 6.4% growth for the first quarter of 2021. That's a huge number. Why that matters is because every 1 percentage point, historically speaking, on a long-term average. Remember, the U.S. economy was at a 3% GDP growth rate from 1966 to about 2008. And from 2008 to the next 8 to 10 years, it was 2% growth rate for the GDP. Why that 1% difference matters when we slow down, and I remember we had in 2008 a lot more regulations, a lot more slowing down. We had a housing crisis back then. We had to grind our way through that, and so markets had to sort of reset to all of the economy at the time, but we had a slower GDP. But from 66 to 2008, we had a 3% growth rate on the GDP for the U.S. economy. So that's our natural growing average. And then we had a 2008 hit, 2%. So that 1% difference, just so you know, it's a good fact to know, 1% difference in a GDP, going from a 3 to a 2% back then, is for every man, woman, and child in the United States. Because the economy is slower, that means economic activity is not growing as fast. That means that you're down $25,000 per every man, woman, and child of economic, basically, opportunity or housing prices or even growth in a business, so on and so forth. So it means a lot. So 1% in GDP is $25,000 per person, over 300 million Americans in terms of translations into dollars. Of asset valuation, so on and so forth. So that matters. So we pay attention to the GDP as we are today. So the first quarter GDP is a huge number, 6.4%. That shows the economy is solid and solidly, coming back and bouncing back stronger. Now, here's what's interesting. In the fourth quarter of 2019, we had a run rate, or the GDP was a $19.25 trillion run rate. And remember, I came to you and I said, listen, the House, the Senate all got together, and the Federal Reserve, and all of them provided stimulus to essentially, at that time, bridge the gap of 1 quarter worth of GDP. Well, let's just do easy math. That'd be $5 trillion if you just divide it by 4 back then. But no, they didn't just stop at the $5 trillion mark, right? We have over $10 trillion of GDP stimulus and status and checks that are going out. 90 million checks went out this last March to U.S. Americans. So households are flush with cash, right? So here's where we are right now. The first quarter GDP run rate is 19.09. This is a 1% difference from our all-time high in 2019. So is the U.S. economy growing? Not yet. This year, it looks like we're on the trajectory to beat this number and grow again. Again, we contracted 2.6% in just 2020 by itself, which is remarkable, all things considered. Now we have vaccines on the way. We have, hopefully, everything is continuing in the right direction. We see travel. I talked to you about high frequency data that we get. Our friends at First Trust are wonderful. They pointed our eyes to that early on when we went through this a year ago, and we paid close attention to that. High frequency data, it's let's look at how much auto sales are happening, or even gas at the pump, or even TSA. How many people are showing up on a daily basis? And right now, as you're watching, that's public information. We're watching the TSA every day, reported numbers. Those are climbing, so travelers are now traveling again, and that's good for other sectors of the U.S. economy, travel and leisure. So we are now going to be firing on all cylinders. We've got a lot of stimulus. Americans are flush with cash. There's a labor shortage. Housing is doing very well. So I think right now we're in a good spot, and corporations are proving that they can make money, whether we're staying at home or now we're going to go out and start spending that additional dollars that we didn't get to spend on leisure and travel last 2020. So right now, that's our update for the day. The GDP was a blowout number. It's all positive for the U.S. economy. We just want to continue to see this persist. But what drives the markets, obviously the backdrop of the economy and the GDP, but earnings. So we're going to keep a keen eye on earnings. That's what matters most, and corporations are doing quite well as we're in the middle of earnings season. So that's our Friday Insights edition. You guys have a wonderful and safe weekend, and thanks for watching.